Ladies and gentlemen, our next panel discussion is going to be on the topic Navigating the Future, Strategic Investments in Fintech Amid Economic Uncertainty and Technological Disruption. To moderate this session, we have here with us, and let's give a very warm welcome to him, Mr. Amit Nawka, Partner Deals PwC. Very, very warm welcome, sir. And joining him, we have our elite set of speakers. So please help me in welcoming on stage Mr. Siddarth Pai, Founding Partner, CFO, ESG Officer, 314 Capital. Ladies and gentlemen, we need some energy from you, so can we have a bigger round of applause, please? Please help me in welcoming on stage Mr. Pavel Gurianov, Principal, FinSight Ventures. So very, very warm welcome. I would now like to invite Mr. Bhavani Rana, Technology Venture Investor, Susquehanna, Asia Venture Capital. And please help me in welcoming on stage Ms. Anuradha Ramachandran, Managing Partner, TVS Capital Funds. Very, very warm welcome to you, ma'am. Thank you so much for joining us. I request you to please take your seat. And over to you, sir.
Thank you so much. Great. Thanks to the panelists for joining in this evening. Modi ji made a very good announcement this morning that more than 30 billion has been invested into the Indian fintech sector. But in the last couple of years, it's slowed. I don't have the numbers offhand, but it's less than a couple of billion maybe. It's really slowed. So that's one data point. The next one, no investment decision today is taken without evaluating the impact of technological changes in AI. So with these two aspects in mind, I would request each one of you to share your perspectives on how do you see the overall funding environment and its slowness in the current market, and secondly, the impact of tech when you are evaluating fintech investments. Anuradha, we will start with you.
Thank you, Amit. And good evening, everybody. Thanks to the organizers for having me on stage today. As we looked, as a growth investor, the slowdown actually is not as apparent because there have been quite a few transactions which have been happening. Not necessarily in the fintech side of things, but more in the finserv part of it. But I would say that technology for financial services is a big theme that has been around for the last few years. We've looked at quite a few of the companies. As you look at, traditional financial services entities like banks, NBFCs, etc., the talk is about the technology investments that many of them are making as well, right? So in that context, you have people who've been working on identity, KYC platforms, which actually manage with the lending systems, the loan stacks as they're kind of called. So there have been many of those kind of investments which have also started coming in, and there's substantial activity. The last decade was one of disruption. You can't expect disruption to keep on happening. It's just that different places, there are places for each one of them in different, you need to have consolidation, and I think that's what we are seeing currently as such. Having said that, I think there is the pace of investments will quickly come back, and we're hoping to see much more.
Right. Thank you.
Let me also just congratulate the organizers for an incredible event, and thank you again for the invitation. I think the context of the decline in investment needs to be taken over a period which acknowledges that 2021 and a portion of 2022 saw an abnormally high FDI that entered in the country, particularly in technology, as a result of what was monetary stimulus or very, very low interest rates, largely in the Western markets, which then found their way here. So as that money has gotten dearer, most investment dollars across are no longer in comparison growing. And so in the context of that, you will see a contraction. Over the long arc of the period, you will see a positive slope. It's a case of we brought forward several periods of investment activity in a very short period of time, and so there's some regression back to the mean. Within FinServe or FinTech side, I think there is a stratification occurring. You do see a lot of the companies that say were in lending being in some way impacted by the way the Reserve Bank is tightening the velocity of lending in unsecured. And so most of the fintechs that you saw raise money were also very levered to that segment. So it's understandable for that to contract. If you look at it on the wealth side, you've also got SEBI that's looking at doing, undertaking some measures, particularly on the F&O side, to slow down the velocity of that. So I think, the element of the regulatory side, which we can talk about further, these do affect the way money is flowing in. And then finally, to your last point about AI, it is clear that a lot of good businesses in India are built on fintech services and fintech SaaS. Mm-hmm. And the questions that investors are looking at are how much of this is going to be impacted and automated or by AI. And right now it's very early to see it. There's a lot of activity that we see bubbling up, but it's not apparent yet that is one of the reasons for the decline.
Right. So I'll just probably ask you a follow-on question. So are there any deals currently in the market which you have heard of or you have seen which is possibly not done because the impact of AI was quite high? Is there any particular segment of the market where you feel that AI will kill existing businesses? Is there something that comes to mind for anyone? Anyone?
I mean, this is the question we ask every time we assess a company these days. Is the company sustainable in the long term, given that AI disrupts it?
Right.
I mean, we passed on many. I wouldn't call the names, but we passed on many because we might be wrong. At least we thought at the time that AI can kill it.
Right. Yeah, okay. So, I mean,
I think one of the businesses that ends up actually lending itself, anything that's actually very human capital intensive for that matter, we have actually seen AI come and end up actually disrupting that entire space as well. So anyone whose growth model is contingent on, I'm going to have an army of salespeople to end up going about, I'm going to end up cold calling people to get them. For that matter, we are actually seeing AI actually come in and actually wipe out those companies.
Right.
And what we've also seen is AI actually has a unique ability to convert entire businesses into features. So standalone products, for that matter, now actually become a feature. Underwriting, which actually there were enough number of startups who came about at one point in time saying, I'm going to do psychometric analysis, I will go through your SMSs, I will go through your WhatsApp, I'll go through your social media, I'll put out 36,000 parameters, ultimately to come up with lending for that matter, and try actually doing it. We've actually seen these kind of businesses who've come about, have actually just become a feature set that's just an API call away.
Right.
So we've seen those entire kind of business models actually go away. We've seen what we haven't seen much AI actually play a role in. If you look at the entire lending stack, which is one of the foremost reasons why fintech companies end up raising so much capital, is because they end up raising that capital not for deploying it into building new technology. It's purely for the purpose of actually lending that money out as credit, which is why the slowdown in fintech lending, fintech funding, if you ask me, is not a bad thing. It actually shows that the tech part of fintech is finally making its way back, where technology is reducing the cost of delivering services. Technology is making these companies far more efficient, for that matter. And we're finally seeing this technology not just happen to fintechs, but to technology companies who end up servicing financial services. We've seen banks, etc., who are woefully inadequate when it comes to their technology investments, end up actually using these companies as of now to compete with the fintechs who are there. And from a NIM perspective, a bank will always have a lower cost of capital to the next new hot fintech that's actually lending out 50 crores or something in a month, for that matter. And we've actually seen these banks realize that. They've realized their own technological inadequacies for the same. They realize the impotence they have when it comes to the tech that they've actually built out, which are built out at a point in time, for that matter, when half their customers weren't even alive. They were built out like in 35 years ago, and they've just been iterating on that same stack. We've seen them embrace technology. And I think that is the part of fintech that people should end up speaking a lot more about as of now, because that is actually truly democratizing fintech, not just to the hotshot engineers who are coming about, but to the fuddy-duddy older legacy banks as well, who now have the ammo to end up actually competing with the next new hot guy who's actually coming out.
right. Very good point. I'll just hold on to the thought, but I'll let Pavel complete.
Sorry, Amit, it's not about disrupting in a negative way, but in a positive way, we do see there's greater amount of efficiency which comes through, right? Like in some of the cases, like if you think of collections as a system,
Yeah.
right? You have a lot of call centers and calling bodies, right? That's a system. You're thinking about languages, right? Like multiple languages. How are you like building those chatbots which actually address customer queries and so on and so forth. A lot of that will see quite a bit of like influence of AI which is going to come into it. And then as a result, hopefully become more efficient. At this point in time, it's too early to say, but at least if you look at the efficiency curve in there, I think there is actually like quite a bit of action which is anticipated.
Right. No, very helpful. Pavel, your views about the funding environment, you invest across the regions, so what's your view?
I guess that most VCs they invest long term, right? And theoretically, short term fluctuation should not affect the investment strategy, but the reality is that it's hard to raise. So we focus, as Siddarth said, we focus on something which can evolve into a substantial standalone business rather than a feature. And such companies usually have to integrate vertically as well as horizontally, which means that eventually you have to compete with incumbents. I think 5 years ago, it was a very utopian idea that you can become, create a macro level outcome without competing with incumbents. You have to, actually. And you have to create multiple products, not just feature. We recently made this investment in Uzbekistan, on a company called Zoom. They have a bank, they have a BNPL, they have credit cards, they have e-commerce, they have government services, bill payments, etc., etc. So multiple products in ecosystem. How can you compete with a company which basically have touch points across so many scenarios of the user? Is what I'm saying. Another point of view, the current scenario, the current macro condition is that maybe companies are raising less because they're trying to raise for something which is already solved.
Right.
AI, many words have been said about AI, particularly very down to earth, and this is a correct way of thinking when you operate in the financial services. However, we as a VC sometimes have to think a little bit more radically to create these moonshot opportunities. For example, can AI create a hyper personalization to turn a bank unique for all of their customers? Or can AI create another mode of interaction with their customers? We usually think of apps, branches, and people as the main interface of interacting, but maybe AI can create a new modality of the interaction.
Right. You spoke about moonshot ideas, and I'll come to Siddarth. You all invest a lot in the early stage. A lot of the fintechs find it difficult to raise, say, the Series B onwards due to multiple reasons. How do you look at capital efficiency in the first 2 to 5 years, 2 to 3 years of any fintech's journey after you've invested?
I think fintech companies who don't end up turning profitable in about 4 to 5 years, for that matter, will have serious existential questions actually posed to them very, very soon. Because I think one of the cornerstones of regulated financial services is continuity of business. And having stable profits that are actually coming in, for that matter, and the ability to grow through internal accruals is a hallmark of a stable business that is there, which is why most of the financial services regulations also either have an enormous net worth or they have a certain profitability criteria that a company needs to meet. Because in case these companies become far too large or if they go down, there are substantial risks and shocks to the financial system, which will be very hard for the system to end up actually recovering because of the intermodalities and the interlinkages that end up actually happening between them. Which is why even when it comes to Series B companies and the rest as of now, most of them have taken this sort of SaaS playbook. Rather than a SaaS playbook, let me rephrase that. They've attempted to build a business the way we used to end up attempting school exams. We know that if this is what the teacher wants, or this is the 3 metrics or the 3 chapters that are important, let me just concentrate on that and screw everything else. So for a bunch of them in lending, it was just, let me just grow AUM. They would raise enormous amounts of money. They would just end up lending equity without building out a liability franchise or have a terrible liability franchise. Don't actually look at collections, for that matter, look at evergreening their loans, which is why we've seen the RBI crack down the way they actually have. And even though everyone believes the B in RBI stands for bully, RBI actually takes a systemic approach when it comes to all of this to say, look, there are certain reasons why secure lending is important. There's a reason why recovery is actually important. Because if the capital tap turns off, we will end up seeing wide-scale business dislocation happen across the entire credit sector, which will end up actually hampering the efforts that the RBI has put in to create systemic stability. So we're seeing that kind of thinking end up actually percolating down to even growth stage investors as of now. You can go to an early stage guy and tell him, you know what, I grew 10% month on month, 15% month on month. They're like, oh, that's great. But life is not a linear equation that you can, or an Excel sheet. You just drag that same cell and you believe that's going to continue unto perpetuity. So these companies who end up struggling to raise don't actually have strong fundamentals. And that's why they'll end up actually getting beaten by guys who may have actually grown slower. But the one thing that humankind doesn't truly understand is actually compounding. As you end up actually with that smaller base, as you end up growing even at a lower rate, the compounding effect actually takes place and you end up actually becoming enormous. HDFC Bank at one point in time was adding an entire Kotak Bank to its balance sheet on a quarterly basis. That is absurd for anyone to end up conceiving of. And Kotak's one of the largest banks that we actually have. A good chunk of India's fintech ecosystem, all our unicorns, can end up actually being equal to the annual profit of SBI. That is actually scale. That is why capital is not a substitute for an effective business model. And the true role of a fintech is managing the financial part, but using technology not just to get a higher valuation, but to actually drive down the cost of delivering and implementing services to their customers. And we're seeing that happen as of now. There's no reason for any of them to have a 100-200% tech team. There are companies around the world that have actually built they built their products which are stable with a tech team of about 15 to 20 people.
Right.
So what is that kind of hiring to end up happening? We've seen the brightest minds of our country, IT engineers who have actually graduated trying to figure out, do I put this speech balloon in yellow or do I put this in blue? They do A/B testing for that. That's worthless. That's why the role that technology plays is to actually lower the cost of services. And fintech companies raising lower amount of money actually means that these companies are either dying away who are inefficient, or they are actually harnessing technology to drive down their costs, thereby preserving the amount of equity they have on the table, and then end up actually compounding over time. We have, I think as an Indian startup ecosystem, failed by comparing financial services to SaaS companies and to consumer companies. I think because we've used the same kind of lens across all three of them, we've seen the kind of fintech boom that has happened, we've seen the kind of fintech bust that has happened, and we've seen the regulator actually step in just to end up giving some amount of sanity to the entire ecosystem that's there. I think that's a realization that's happening now. But the good thing is the next generation of entrepreneurs coming about, they actually respect this.
Right.
They don't come out with crazy, absurd business plans that they can never end up achieving. They've actually become a lot more sober, they become a lot more rational. And these are the kind of guys, when everyone asks, where's the next HDFC Bank? HDFC Bank never came out never started out by saying, I'm going to churn out a Kotak every quarter. It happened. But it takes them 30 years.
Right.
We need to give them time. I think that patient capital that's coming in, and the fact that entrepreneurs understand they're no longer going to be have stopped comparing themselves to consumer companies, is actually a fantastic hallmark for the maturity of the Indian fintech ecosystem.
Right. I don't know, Bhavani, you've got anything to add to what Siddarth had mentioned, but I have one other question for you as well. You have spent a lot of time investing and evaluating companies in the banking infra space. We've already spoken a lot about how fintechs have to exist with incumbents. You go deep in a vertical or go horizontal. What's the investor's view on when you're evaluating a banking infra player about having banking partnerships?
So I think if you're an investor in that segment, or even if you're a stakeholder, an employee, the best thing you can have is a bank as a customer. But the worst thing you can have is a bank as a customer as well, because you get all excited about having the customer, this big logo. And what typically happens is it could be incredibly game-changing for the startup, but it is of extremely small scope for a bank to start with. And it's that asymmetry of the way they look at things that needs to be understood better, both by the company, but by the investor that's investing and guiding them. So to put a finer point to this, the way you would, as an entrepreneur or a management team, navigate through that is to understand what are the measures of success that the bank is trying to achieve with your pilot. So typically it'll always start with the pilot will scale. This is really important because most projects that start with that, they go straight from the peak of inflated optimism on signing straight to the trough of disillusionment when it doesn't scale. and then everybody's sort of scratching their head. So for an investor, the lens you want to look at is how realistic is this? Every startup thinks it's got groundbreaking technology. The best thing you can have is you have it piloted start with one division of the bank. Banks in India tend to operate also with, each division has a lot of agency in its determination of who they want to work with. They could work with the same kind of vendor, but with different, so HDFC may use, one division might use a KYC for one, and through one vendor, it might be using a KYC onboarding, another department may use. So what you want to really understand is, what are the measures of success? What's the realistic outcome from there before you really start committing resources? And then understand that the best thing you can do for yourself is to percolate one division at a time, right? So typically sometimes there's a very attractive feature that most of the bank departments want at the same point of time. It's going to be impossible for you as a startup really to service so many different departments concurrently with your limited bandwidth. So managing that, because if you fail on getting yourself out of the gate and managing those expectations, you're not going to be able to scale within that bank. But if you can be patient and you can navigate through those, the bank can be an extremely good diffusion channel for you. So there are several really good bank infrastructure software companies that have grown tremendously over the years because they've figured out how to serve the banks, and they've started off with one department, one division, crosswalked across there, but then within those they've grown. So those, in summary, would be what an investor or a stakeholder would want to look at.
Right. Whenever, I have seen banking infra players, there is always, I believe that there is some kind of a dichotomy where if you're getting into the core of the banking system, a bank would want to possibly invest into the company, like to have a visibility of it. But then does that probably stop the fintech to go and approach other banks, who are not on the cap table? Is there any friction over there in such companies?
So I think, I can speak from experience where we have HDFC invested in one of our companies, but firstly, the regulator limits the extent to what their ownership can be. Second is that if you look at it, most of the banks understand that you're going to have, even if you're a technology provider as an infra thing play, you're going to be you're not touching the customer directly. Now, what tends to happen is they may want some exclusivity if they're committing a lot of resources, and that's really for the board of the company to determine for it. But my experience has been that the banks don't push, for exclusivity. It's a very symbiotic relationship because they understand that this diffusing across can be advantageous for the entire system. And on the whole, I don't think it's a net negative to have them as an investor. What you do have is you have to manage any board. If you bring another large bank, for instance, that bank would have concerns over whether the scale of their customer, their projects or something are being exposed. But companies can manage that.
Right. So Anuradha, if I would ask you the next question, which are some of the hot fintech sectors currently which investors are evaluating? Are there any emerging trends that you're seeing in the market?
Well, if you go, absolutely. If you thought about the last few years being the years of lending, now has been perhaps like where you're seeing that as companies turn towards scale and profitability, you've realized that the top end of the pyramid is where you compete in, and therefore wealth is actually like one of the themes that is playing out substantially right now in terms of, in fintech. The second, it's to be candid, that's a very difficult ball game, right? And you see quite a bit of where you're trying. Most businesses are tech enabled. Are they tech first? Is a question which happens. So fintech by definition is also morphing a little bit. Because wealth by definition again is a services business, right? Like, and you're using technology to build efficiencies out there. So that's one part actually like where we are seeing quite a bit of activity which is happening. The second is in terms of like, again, a tech-enabled kind of perspective coming in from, as we were just discussing, the banking technology or the core operational technology that's happened. And there's quite a bit of like work to be done there. It's quite astounding that over the years as we've kind of like progressed, the landscape itself has changed so much that it becomes very difficult at some point in time, I think like Siddarth mentioned it earlier, to sellotape legacy systems, right? So you have to kind of like, like build out or hollow out some of this. So hollowing out the core is something that people are talking about, right? Like banking journeys are what people are talking about as such. While there are some of these hot themes which are out there, it is also important to demonstrate. In some of these cases, is the Indian market by itself large enough? Is a question that growth investors like us ask, right? Standalone, for instance, in the technology infrastructure space, we're not too sure, right? Given the spends that are happening. If you look at like the shift in spends, it's substantial, but in depth of spends, it's not yet, right? And the second part of it is in terms of like, the per unit values being actually like, banks are extremely, Indian service providers are extremely value conscious, financial service providers as such. So that's not changed substantially. So is there enough depth in India as a market? It's not yet clear, right? Therefore, you have to kind of like go to other countries. And it's very difficult to just plug and play a technology, right? You have to like kind of adopt it to the local way of doing business, which is consumer facing, and way of doing business, which is the back end and the regulator facing as well, right? So it's not as though like, here's a technology, what you've run in India can be, like ported into another country. It requires substantial amount of reworking as well.
Right.
So that's a question which has not yet gotten answered for us.
Right.
But that's, like where we are keeping our eyes out at the moment between wealth and this. Insurance, technology in insurance is something that's never been spoken about in large, but it's a very large industry and it can't run without technology, right? So that's the next area where we think which we think is ripe for disruption. And we're looking at a few companies out there as well. But that's much more a consolidating space, which is in the growth kind of segment, but as opposed to the early stage innovation kind of segment.
Right. Pavel, you are investing across various geography from your fund. Just building on what Anuradha mentioned about, say, India for global, in the banking infra topic. Do you see different levels of innovation in different countries? Or how do you think about investing in one country over the other?
Of course, every market is unique, and some markets there are like opportunities, as I mentioned in my first answer, to bundle a lot of stuff together. In India, it is not possible. Every market is unique. You can't really diversify your fintech strategy because you have to. Fintech is very local kind of a play, and navigating the regulatory landscape in one region is tough. Doing this across the dozen is impossible. So you have to be very local. And when we select markets, none of them are ideal, first of all. But when we select markets, we usually focus on few things. First of all, is the regulator ready to accept new entrants? This can come in various forms. Either issuing new banking licenses or issuing a new types of banking licenses, like in Korea or Philippines, or ability to rebundle the banking license by creating a setup of different fintech licenses, like in Brazil. In the end of the day, there is no country in the world which allowed to do so, but did not benefit from that. Second thing we are looking for is the consistency of policymaking. As I said, we see is at least 10-year play. You can't really invest if your policy changes a few times during this period of time. And probably the last thing, not least obviously, is an existence of developed ecosystem of local investors. Because we are global, we can bring this global view pretty early stage, but we can be that aware of the regulation as people on this panel.
Right, right. We just have time for one other question. Maybe I'll ask you, Siddarth. While the total funding in the Indian fintech system has slowed, in the ecosystem has slowed, but the number of M&A has actually increased. A lot of M&A has been done by payments players and as well as banking infra. So if a portfolio company of yours who's doing well comes to you, say that he's got an amazing acquisition offer from a larger fintech or a bank, how do you decide, or how does the founder decide whether to stay on, build it out, or to exit?
I think the first and foremost is price. I think everyone who gets into investing or actually gets into startups for that matter has a price. And the moment that price number is hit, their priorities obviously end up actually changing. So that actually has a role to end up actually playing there. But what we've seen happen in the M&A landscape, especially as of now, is a weaponization of your balance sheet. There are certain companies whose founders are exceptional at actually raising capital. The business models may be a little shaky, so they'll take time to end up actually scaling that up. But they have actually weaponized their balance sheet to pick up these choice assets all over the place. And entrepreneurs have actually suffered, especially I think technology entrepreneurs have suffered from actually being fantastic when it comes to coding, terrible when it comes to actually convincing an investor to end up actually taking a punt on them. Whereas some of them are fantastic when it comes to raising capital, terrible when it comes to actually building a business. So in the short term, the guys who end up actually raising that capital have the ability to attract and collect these sort of Lego blocks and actually end up creating a super app by themselves. So if one of these companies ends up actually coming up over there as of now, we'll end up actually looking at it from the founder fit. Is our founder actually lacking in some of these skills that are easy to end up actually getting from the market, such that they can end up actually scaling? Number one. Number two, for that matter, when the acquisition offer ends up actually coming in, are you going to be the fundamental differentiator to that particular business, for that matter? And the third part we end up looking at is, if you were actually supplied with the capital that you required, can you end up actually replicating your acquirer's business model, or actually end up disrupting the same as well? So I think that ends up actually playing a role over here. What we have seen happen is some of the M&A situations that have occurred over the last 24 months especially, they've been distressed M&As. Guys who've actually managed to raise in 2020, towards the end of 2021, just in the beginning of 2022 for that matter, and have managed to end up conserving cash. It's been a veritable bonanza and a buffet for them to end up actually picking up quality assets at throwaway prices. So we've seen the sort of disruption end up actually coming over here. And what we've also seen is some of these founders who've gotten picked up for cheap, and they've actually exited that previous company that acquired, the company that acquired them, they come back with a visceral hunger to end up actually proving it wrong. And they have a deep understanding of what their personal limitations are. So they cobble together a founding team that actually rounds out the edges that they had. And when they end up hitting the market and when you end up actually funding them, what a fintech would have normally taken 5-6 years to do, these guys can achieve in the span of 1.5 years. And that's a fantastic set of founders to actually come up. So that M&A is actually good for the ecosystem to unlock capital, for that matter. It's also great for the ecosystem because some of the people who got shafted in that M&A come out with such a amazing, with such pure hunger that's actually there, that they will end up actually creating the new wave of disruption that this industry sorely needs.
Right. Well, thanks for that. I don't know if the audience has any questions. We can take one or two from the audience. Yes, we have got, I don't know whether we can get a mic across to you.
My question is to Siddarth. Siddarth, we have seen that fintech is on kind of a diminishing or maybe stabling, right? There is a tech fin vertical within this whole, like people were talking about infra. The supply chain financing is one of the area which is not still coming up in India. I don't know why, because we have good number of businesses in India, good number of rated companies, but supply chain financing as a practice is not much in Indian enterprises. And also the current ecosystem is further creating an intermediation, right? Like between enterprise and lenders, right? Even we are running a government-led model, which is very unique in India, and there is no one doing it across the world. What is your view that, what are the areas of efficiency coming around it? I'm building around that. I'm building Factorwise, which is, we want to kind of create an ecosystem around this where the efficiency is being, the incremental efficiency is being created in this supply chain financing.
I think the question is clear.
No, so happy. So I think, see, one of the reasons why we don't actually have these sort of factoring or supply chain financing companies is our larger companies are actually terrible when it comes to making payments. There are numerous hacks that exist, even though the fact that if you're an MSME, you have to pay it within, I think, about 45 days or 90 days. Otherwise, you report it to the department, to the Ministry of Corporate Affairs, etc., etc. If you actually go into the nuts and bolts of it, the larger companies have numerous ways to end up actually circumventing the regulation. So everyone has tried to get into supplies, even with GST coming out as of now, the GST invoices prove the creditworthiness of that particular company. You know for a fact they'll end up actually paying it, etc. The payment cycles end up getting stretched to such a large extent that your financing costs actually end up shooting through the roof. So that intent, and there are numerous large companies who are listed who gloat about the fact that they had to have negative working capital cycle because they squeeze their vendors to such a large extent that it's next to impossible for them to end up actually surviving. So unless those kind of, and this is not a technology innovative play that can end up disrupting it. It's a fundamental change in the way larger businesses end up actually looking at these smaller MSMEs as a means of financing. And the fact that our regulations only exist on paper as of now without actually attaching the core of the issue. And if we end up solving these two particular bits, supply chain financing is something that should end up being a far larger industry in India compared to what it is as of now. So technology does have a role to play. If there is a way to end up actually holding these larger companies accountable, I think that will be the key to end up actually cracking that issue and to end up creating a very large, very profitable, scalable enterprise.
Right. Thanks for that. We've covered a number of topics from the flow of capital, India versus the rest of the world, M&A. I think it has been very insightful. Thank you so much, all the panelists. Some of these aspects are covered in a PwC report, which we have been releasing today. It is covering in the state of the funding in the Indian fintech ecosystem. And we'll release that report now. Thank you so much. Thank you, everyone.